Most people spend their entire lives building wealth together. Decades of work, sacrifice, smart decisions, painful trade-offs, all of it designed to protect the person they love most. The plan feels solid. Retirement accounts, a home that grew in value, investments, life insurance, maybe even a small inheritance tucked away. Everything seems secure. And then one spouse passes away first. Suddenly, without warning, without dishonesty, without any mistake, the government reaches into everything that couple built together and takes a cut so large it changes retirement forever. This is not a conspiracy theory. This is not a rare situation. It happens to millions of surviving spouses across America every single year, and most people have absolutely no idea it's coming until it's already too late. Today, we're talking about 4 specific assets most families already own, that can trigger massive tax consequences the moment a spouse dies first. Some of these will shock you. One of them almost nobody talks about. And understanding all 4 could save a family hundreds of thousands of dollars. If you're new here, hit the like button and subscribe right now. We cover financial traps, tax strategies, and wealth protection secrets most people don't learn until it costs them dearly. Here's what makes this so painful. The U.S. tax system is actually generous to married couples while both spouses are alive. Couples get joint filing status, lower tax brackets, larger deductions, and survivor benefits that help stabilize income. But the moment one spouse passes away, everything changes. Fast, permanently. The surviving spouse enters what tax professionals quietly call the widow's penalty. Suddenly, the same income gets taxed at higher single-filer rates, while inherited assets carry hidden tax liabilities the survivor never expected. The first dangerous asset is something almost every American household owns, a traditional IRA or 401k. Most people think they already understand retirement account taxes, but what happens after a spouse dies is far worse than most realize. When both spouses are alive, required minimum distributions are spread across 2 lives. The withdrawal stays smaller, the tax hit stays manageable. But after one spouse dies, the surviving spouse becomes the sole owner of what may now be a very large retirement account. And because they're now filing as a single taxpayer, the exact same withdrawals can push them into dramatically higher tax brackets. Imagine a couple where each spouse has a $400,000 traditional IRA. Together, they have $800,000 saved for retirement. While both are alive, withdrawals stay manageable. Then one spouse passes away. The surviving spouse now controls the full $800,000 account balance alone. Required minimum distributions on that amount can easily exceed $32,000 per year before taking a single dollar for actual living expenses. That extra income, combined with Social Security, can push the survivor into a tax bracket that feels almost punishing. Over a 15 or 20-year retirement, this becomes a 6-figure tax problem, quietly draining wealth year after year. And here's where it gets worse. Most couples never do Roth conversion planning. They spend decades deferring taxes because it feels smart in the moment. And honestly, it often is smart, until the wrong spouse dies first. Now the surviving spouse is trapped holding a massive pre-tax account with terrible options. Convert to Roth later. Huge tax bill as a single filer. Don't convert. Taxes continue compounding for years. Financial planners call the years immediately after a spouse's death the conversion opportunity years. This is the short window before mandatory distributions begin, where strategic Roth conversions can save extraordinary amounts in taxes, but almost nobody acts because almost nobody gets warned in advance. The second dangerous asset is something most people think of as a blessing: appreciated investments held in taxable brokerage accounts. Stocks, mutual funds, ETFs, REITs, anything outside retirement accounts that grew significantly in value. Most people never think about cost basis until grief and taxes collide at the same time. Imagine a couple bought $50,000 worth of stock 20 years ago. Today it's worth $300,000. That means there's a $250,000 unrealized gain hiding inside the account. If they sold it while both were alive, they'd owe capital gains taxes on that appreciation. Potentially tens of thousands of dollars. But here's the powerful tax rule most people never fully understand. When a spouse dies, the surviving spouse may receive a step-up in basis. The cost basis resets to the market value on the date of death. That $300,000 stock position, the new cost basis becomes $300,000. The $250,000 gain disappears from a tax perspective entirely. If sold immediately after inheritance, there may be zero capital gains tax owed. That is one of the biggest legal tax advantages in the American tax system. But there's a trap. The step-up only applies to assets actually owned by the deceased spouse or jointly held at death. Assets solely in the survivor's name may not qualify. Assets gifted before death may lose the benefit entirely. And retirement accounts like traditional IRAs and 401ks, they do not receive a step-up in basis. That's why retirement accounts often become the worst tax asset after death, while taxable brokerage accounts become the best. The third dangerous asset is the family home. Most couples know they can exclude up to $500,000 of capital gains when selling a primary residence together. But after one spouse dies, that exclusion gets cut in half. The surviving spouse, now filing single, usually only qualifies for a $250,000 exclusion. For families who bought homes decades ago in places like California, Texas, Florida, or the Pacific Northwest, this creates an enormous hidden tax bomb. Imagine a couple bought their home in 1998 for $180,000. Today it's worth $820,000. That's a $640,000 gain. While both spouses are alive, they can exclude $500,000 and only pay taxes on $140,000. But after one spouse dies, the exclusion may fall to $250,000. Now the taxable gain jumps to $390,000 instead of $140,000. That difference alone can create tens of thousands of dollars in extra taxes, simply because one spouse passed away first. And in high tax states, the combined federal and state bill can become devastating. This is where community property states become incredibly important. States like California, Texas, Arizona, Nevada, Washington, Idaho, Louisiana, New Mexico, and Wisconsin often allow both halves of jointly owned property to receive a full step-up in basis at death. That can completely erase the taxable gain on a home sale. But in most non-community property states, only half the property receives the step-up. The surviving spouse keeps the original basis on their half. The tax difference between those two systems can be worth tens or even hundreds of thousands of dollars. Now let's talk about the fourth asset, the one that blindsides people the most: life insurance. Most people believe life insurance is tax-free, and in many situations, it is. A surviving spouse receives the death benefit and owes no income tax on the payout itself, but hidden problems appear when the policy is structured incorrectly. If the estate is named as beneficiary instead of an individual, problems can emerge. If the deceased owned the policy personally, and the estate exceeds exemption thresholds, problems can emerge. And if Congress allows current estate tax exemptions to expire after 2025, millions of higher net worth families could suddenly face estate taxes they never expected. A large life insurance payout can push an estate above future exemption limits almost overnight. That's why wealthy families often use irrevocable life insurance trusts to keep policies outside the taxable estate entirely. But there's another trap affecting ordinary families too. Interest earned on life insurance proceeds sitting inside an insurance company holding accounts is fully taxable income. Many grieving spouses leave the money parked temporarily while deciding what to do next. Then tax season arrives, and suddenly they receive a 1099 form showing taxable interest income they never expected. Now, imagine all four of these problems hitting the same person at once. Picture a couple in their late 60s living in Virginia. They own a home worth $650,000 purchased decades ago for under $200,000. Each spouse has a $350,000 traditional IRA. They own appreciated brokerage investments, and there's a large life insurance policy. On paper, they seem financially prepared. Then the husband dies unexpectedly. The surviving spouse suddenly inherits a giant IRA balance now taxed at single filer rates. Only part of the brokerage account receives a step-up in basis because Virginia is not a community property state. The home sale exclusion drops from $500,000 to $250,000. The life insurance holding account starts generating taxable interest income. Within just a few years, the surviving spouse could face well over $100,000 in taxes from assets they thought were completely safe. And none of it happened because they were irresponsible. It happened because they didn't understand how dramatically tax rules change after the first spouse dies. What makes this even harder is that the surviving spouse is simultaneously dealing with grief, loneliness, paperwork, and financial decisions for the first time alone. The tax code does not pause for heartbreak. The IRS does not care that someone is grieving. The bills still arrive. The deadlines still come. The penalties still apply. So what can couples do right now to reduce these risks? First, begin Roth conversion planning while both spouses are alive and filing jointly. Every dollar moved into a Roth today may help avoid the widow's tax penalty later. Roth accounts avoid required minimum distributions and create far more flexibility for survivors. Second, understand exactly how brokerage accounts and appreciated assets are titled. Asset ownership matters enormously after death. Community property rules matter enormously after death. Third, understand the future tax consequences of the family home, especially if the property appreciated significantly over decades. And fourth, review every life insurance policy carefully. Who owns it? Who are the beneficiaries? Is the estate named anywhere? Would a trust structure provide better protection? Most importantly, have the conversation now while both spouses are alive, Sit down with a financial advisor, CPA, or state attorney and actually run the numbers. Look at the tax projections. Understand exactly what happens financially if one spouse passes first. Most couples never do this exercise, and when they finally see the numbers, they're stunned. The American financial system offers powerful benefits to married couples, but it can also become brutally expensive for the surviving spouse who wasn't prepared. This isn't about fear, it's about clarity, because the person left behind deserves the ability to grieve without simultaneously discovering that their financial security was quietly collapsing underneath them the entire time. The 4 assets we discussed today, retirement accounts, brokerage investments, the family home, and life insurance, make up the core wealth of most American families. And every one of them carries hidden tax risks that activate the moment one spouse dies first. The strategies to prepare exist, the tools exist, the window to act still exists, but preparation starts with understanding the risks before they become irreversible. If this video helped you see something in your financial plan differently, share it with someone you care about. This information protects families. And sometimes, the most valuable financial conversation you'll ever have is the one that happens before a crisis begins. Drop a comment below and let me know, which of these 4 tax traps worries you the most? The retirement account problem, the home sale taxes, the brokerage account rules, or the life insurance issues? Like the video, subscribe to Money Insight, and I'll see you in the next one. vidIQ.